Alright, this is just going to be a short video that discusses the sort of the pros and cons of debt versus equity. Right, when a company is looking to expand and they need a large sum of money for an expansion, a strategic acquisition, just to change their direction, add new product lines, to do something significant, right? Not for the day-to-day operations, but for large strategic changes, they have a choice of financing through debt or equity, or a combination of the both, right? So these are two potential sources of big money. If we think about the accounting equation, assets equal liabilities, so that's the debt, plus owner's equity. Those are the two sources of financing for the assets. So let's look at the advantages and disadvantages first of debt. Well, debt, so liabilities. Some of the advantages, you're not going to have a change in the relative percentage of ownership control when you borrow. But when you borrow, interest is also tax deductible, so that's a good thing. And there is a potential to increase. ROE stands for return on equity through leverage. So leverage is a fancy way of saying through borrowing we can actually increase our return to equity. And by that we mean if we borrow money, let's say at 5%, and we invest in a project, and the project earns something greater than 5%, then we've actually increased our profitability by strategically using the debt. So even though we have to pay a 5% rate, if we're earning 8 or 9 or 10%, then we're making money by borrowing money. Some of the disadvantages to debt is that there is also then the potential to decrease your return on equity if the return is less than you forecast, or the cost of borrowing increases. You can actually hurt your profitability. And interest has to be repaid. You can put yourself in default, technical bankruptcy if you don't make your interest payments. And at the end, you have to repay the face value of the bonds. So you have to be careful if you're going to be using debt for financing. There are advantages, but there are also disadvantages to be aware of. Equity, the number one advantage would really be that you're not required to pay dividends. No one can force a company to pay a dividend. The disadvantage, though, is what's viewed as double taxation of dividends. The company can only distribute prior profits, right, and that's on an after-tax basis. So the company has to pay the corporate tax in order to have profit, and then in order to then distribute that profit to the owners, the shareholders, through the form of dividends. But then when those shareholders receive the dividends, that's taxable income to them, and they pay tax on it again. So the corporation pays taxes and the shareholder. It's a big disadvantage. So no one's forcing you to pay the dividends, but when you do, it's all after tax, in fact, after double tax. And so the sources of funds for equity financing are somewhat wider, right? To borrow, you have to meet certain requirements. You have to find a lender or an institution or a series of investors who'd be willing to lend you the money. Sources of equity financing are a bit broader. You can, go to your friends. You can use a venture capital firm, etc. So this just gives you a broad overview of the two major sources of large capital funding.